Welcome back, everyone. If you're a focused learner looking to master the actual mechanics of the financial markets, you've landed in the exact right place. Today, we're bringing you a brand new explainer on fixed income management and strategic bond analysis. And let me tell you right up front, if you think bonds are just, boring, dusty certificates sitting in some vault, well, you're in for a massive surprise. What we're diving into today isn't dry theory, not at all. This is a highly dynamic playbook used by top portfolio managers to generate massive returns and protect global wealth. So let's jump right in and decode how these strategies actually work out there in the real world. So let's rapidly establish our foundation here. What exactly is fixed income? At its core, fixed income investing involves securities that basically promise you two very specific things: periodic interest payments and the repayment of your principal at maturity. That's the baseline, the whole shebang. Whether we're talking about government bonds, corporate bonds, short-term treasury bills, or even those complex municipal and mortgage-backed securities, the fundamental promise is exactly the same. You lend money, you get paid interest over time, and eventually you get your initial investment back. Here's the agenda for our journey today. We're going to cover fixed income investing foundations, then passive strategies and stability, switch gears to active strategies and returns, and finally look at navigating risks and modern AI. And I promise you, the stakes here are very real. We're going to look at dramatic moments like the 2022 UK pension crisis and the COVID bond panic. It's going to be a fascinating ride down these two very different paths.
Okay, Section 1, Fixed Income Investing Foundations. The two-path toolkit. Let's look at the tools you need to survive market volatility.
You see, managing fixed income isn't just about buying a bond and going to sleep. Not anymore. Broadly speaking, these strategies divide into two distinct philosophical paths. It's a literal fork in the road. On the one side, we have passive strategies. These focus entirely on stability, predictable returns, minimizing trading, and keeping costs as low as possible. On the other side, active strategies are all about outperforming the market or the index through intense economic forecasting, credit analysis, and tactical positioning. So it's basically the steady quest for predictability versus the dynamic hunt for alpha.
Which brings us to Section 2, Passive Strategies and Stability, playing defense. Let's get grounded here.
When you're playing defense, the goal isn't to beat the market at all. It's to preserve capital, manage risk, and match your future liabilities with absolute certainty. The absolute most fundamental defensive play is the buy and hold strategy. The investor simply buys bonds and holds them all the way until maturity. Why? For stable income, predictable cash flows, and super low transaction costs. A great real-world example? Many retirees in India use this exact strategy with government securities or fixed deposits. If an Indian retiree buys a 10-year government bond with a yield of 7.5%, it honestly doesn't matter if market rates fluctuate wildly tomorrow. They just continue receiving their coupons and get their principal back at maturity. It prioritizes safety and low stress above all else.
Next up is the indexing strategy. Now here, a portfolio is built to just mimic a bond index rather than try to beat it. Think of something massive like the Bloomberg Global Aggregate Bond Index. Mega firms like BlackRock with their iShares or Vanguard have really popularized this approach through bond ETFs. And these funds, they absolutely exploded in popularity after 2020. Why did that happen? Because investors were desperately seeking out diversification, extremely low costs, and just stable market exposure during crazy times.
Okay, pay close attention to this one, because it's a massive, absolute game-changer concept in fixed income analysis. DA equals DL. This is the core mathematical formula for an immunization strategy. Asset duration equals liability duration. The whole goal of immunization is to protect a portfolio from interest rate risk. By perfectly matching the duration of the assets you hold with the duration of the liabilities you owe, you ensure that future liabilities can be paid out regardless of how interest rates change. Pension funds use this literally all the time to make sure they can actually pay retirees in the future.
But what happens when immunization strategies face massive, totally unprecedented stress? Well, take a look at the messy reality of the 2022 UK pension crisis. A lot of UK pension funds had matched their liabilities using long-duration bonds and derivatives. But in 2022, UK gilt yields rose so sharply and so fast that bond prices simply collapsed. Margin calls spiked, liquidity dried up instantly, and it triggered massive system-wide stress. It got so bad that the Bank of England actually had to step in and intervene to stabilize the markets. It is hands down one of the biggest modern examples of exactly what happens when fixed income risk management fails.
So, to avoid the complexities and pitfalls of duration matching, some folks use cash flow matching. Instead of matching duration, you match the exact future cash flows.
Say a company knows it absolutely must pay 10 crore in 5 years and another 20 crore in 10 years. They just buy bonds whose exact coupon and principal payments match those obligations perfectly. The massive advantage here? It practically eliminates reinvestment risk.
All right, moving right along to Section 3, Active Strategies and Returns, Playing Offense. Time to pick up the pace a bit.
When we play offense, we leave the safety of matching liabilities completely behind. Here, managers are forecasting economics, predicting interest rates, and aggressively analyzing credit to beat the market. And the crucial point of active management relies heavily on this single mathematical relationship, a massive CFA Level 1 concept, by the way. Price is inversely proportional to yield. This is the cornerstone of the interest rate anticipation strategy. If managers expect interest rates to fall, they buy long-duration bonds, because bond prices rise when yields fall. Conversely, if they expect rates to go up, they shift rapidly toward short-duration bonds, floating-rate securities, or, honestly, just plain cash. And here is that inverse relationship generating truly exceptional returns in real life during the 2020 COVID-19 panic. Portfolio managers who successfully anticipated that the U.S. Federal Reserve was going to cut rates aggressively, they made their move. They bought long-term Treasury bonds early. When the Fed actually slashed rates, yields collapsed, and those managers saw massive price appreciation. Some long-duration Treasury ETFs generated absolutely huge returns simply by getting that one interest rate forecast right.
Another offensive play is the credit strategy, where managers attempt to profit from changes in a company's credit quality. Take Tesla bonds, for example. Earlier in the company's history, their bonds traded with very high yields due to significant credit concerns from the market. But as Tesla's profitability improved, their credit spreads narrowed and bond prices rose. Active investors who recognized those improving fundamentals early, they earned incredibly strong gains.
Active managers also try to profit from changes in the shape of the yield curve itself. Think of the bullet strategy as a highly targeted weapon, concentrating your portfolio's maturities around one single point, like 5-year bonds. That's best used when you expect the yield curve to flatten right there. Then there's the barbell strategy. Think of heavy weights on both ends, holding short-term and long-term bonds while completely avoiding the medium maturities. This brilliantly combines the liquidity of short bonds with the higher yields of long bonds. Finally, the ladder strategy. It's exactly what it sounds like, an even step-by-step distribution across different maturities.
And while laddering is a famous institutional strategy for reducing reinvestment and timing risks, it's also highly personal. Look at how it's used in real life. Wealth advisors frequently recommend bond ladders, buying bonds that mature in, say, 1, 3, 5, 7, and 10 years to stabilize cash flows for everyday retirees. It provides steady liquidity and basically takes all the guesswork out of volatile interest rate cycle.
Then we have the spread trading strategy. Let's walk through this timeline of the 2020 corporate bond market panic to see it in action. In early 2020, fear completely dominated the markets, and corporate bond spreads exploded. Managers using spread trading bought quality corporate bonds right during this intense panic, fully expecting the unusually high spreads to narrow later, and they were right. By mid-2020, central banks stepped in to support the bond markets, and by late 2020, spreads narrowed sharply, meaning those investors captured substantial profits just from exploiting market fear.
Now here is an incredibly clever tactic: riding the yield curve. This strategy exploits the natural upward slope of the yield curve, where longer maturity bonds usually have higher yields. The concept is surprisingly simple. You buy a 10-year bond. As time passes, the bond's maturity naturally shortens. After 2 years, it's an 8-year bond. Because it's shorter maturity now, its yield declines, and therefore, its price rises. You sell it, capturing not just the coupon income, but also the price appreciation. It's a really slick move.
But hey, what if you want the thrill of active management, but also the absolute mathematical protection of immunization? Enter contingent immunization. It's a brilliant hybrid approach. Step 1, you manage the portfolio actively, taking risks for higher returns. Step 2, you constantly monitor the value against a strict safety threshold. Step 3, if your active bets fail and the portfolio value drops to that threshold, you instantly stop playing offense. You switch entirely to passive immunization to guarantee your liabilities are met. It's basically an active strategy with a built-in mathematical safety net.
Finally, let's look at Section 4, Navigating Risks and Modern AI, the Future of Fixed Income.
Look, whether you are playing passive defense or active offense, you absolutely must manage the overarching market threats. Here's a quick summary so you aren't overwhelmed. You've got interest rate risk, where rising rates drop bond prices. Credit risk, the danger of the issuer actually defaulting. Reinvestment risk, which is the reality of having to reinvest your coupons at lower rates. Liquidity risk, finding it hard to sell a bond when you really need to. And inflation risk, where your fixed returns simply lose their purchasing power over time.
Now, how are modern portfolio managers handling all of this today? Through AI and modern fixed income strategies. Firms are supercharging their toolkits with machine learning and massive big data analytics. We're talking tools from Microsoft Copilot, Bloomberg, and BlackRock's legendary Aladdin system. These help managers analyze yield curves, macroeconomic data, and inflation expectations at literal lightning speed. These AI-driven systems process thousands of bonds, real-time news, and market sentiment simultaneously. The days of just looking at a static spreadsheet, yeah, those are long over.
And that brings us to the core takeaway of this explainer. As this quote from our source material perfectly outlines, understanding these strategies, both the passive pursuit of stability and the active pursuit of alpha, is absolutely essential for bond portfolio management and risk management. Fixed income is about generating income, preserving capital, and yes, occasionally strategically outperforming the markets. They are far more than just boring safe assets. So, after diving deep into the foundations, the heavy math, the real-world crises, and the AI-driven future of it all, I want to leave you with a question. As you look at managing wealth, which path will you trust with your financial future? The absolute safety and predictability of passive defense, or the high-stakes, highly dynamic alpha of active forecasting? Think about it. Thanks so much for joining me on this explainer, and keep learning.